Hello, commerce students. Welcome to Commerce Sensei. Today's topic is very important. We will discuss accounting rules. These rules are fundamental. We look at the golden rule and also the modern rule. Let us understand them clearly. Accounting rules are truly vital. They guide how we record all of our business dealings. These dealings are called transactions. Two main methods exist for this. To apply these debit-credit rules, we will learn about both today. So stay focused, dear students. First, let's understand the pillars, the main pillars of accounting. There are 4 such pillars. They are assets. Think of your own mobile phone, your bicycle, or even your laptop. These are assets you own as a student. For a small business, assets could be the shop's cash register, inventory, or delivery van. They are liabilities. If you borrow money from a friend to buy a textbook, that borrowed amount is your liability. For a business, a loan taken from the bank or money owed to suppliers are liabilities. They are expenses. When you pay for your daily bus fare, buy lunch, or pay for internet data, these are your expenses. For a business, expenses include paying salaries, electricity bills, or rent for the shop. And finally, income. If you receive pocket money from your parents or earn by tutoring a friend, that is your income. For a business, income is the money earned from selling goods or providing services. These are the absolute basics. Understanding these 4 pillars is crucial. Assets, liabilities, expenses, and income. They form the very foundation of all the accounting work you do. Before you learn debit rules and before you learn credit rules, you must grasp these concepts first. Your Commerce Sensei advises this strongly. Let's dive deeper into assets, one of the most important parts of any business. Assets are valuable resources that a business owns and uses to operate and grow. These can be physical things, like buildings, vehicles, or computers. Assets can also be intangible, such as patents or trademarks, which give a business special rights or advantages. Investments, like shares or bonds, are also considered assets because they can bring future benefits. All these assets provide future economic benefits to the business. For example, cash in the bank helps pay for supplies, and computers help employees work efficiently. A delivery van or a company car is an asset that helps transport goods or people. Or large buildings and property, which are used for business operations. Or machinery used for production, which helps create products. All these assets help the business function and grow. Assets are usually bought as capital spending, which means the business expects to use them for many years. This is called a capital expenditure, or CapEx. For example, buying a new computer for the office is a capital expenditure because it will be used for several years. These are often significant investments, meant to last and support the business for a long time. They are meant to last many years and help the business expand its capacity. For example, buying a delivery van is a capital expenditure, as it will be used for many deliveries over time. This van is an asset for you and your business. Now, let us look at expenses, which are different from assets. Expenses are the business's costs, spent to keep things running day to day. For example, paying the monthly electricity bill is an expense because it is used up quickly and must be paid again next month. Buying office supplies like pens and paper is also an expense because these items are used up quickly. Advertising costs like putting up posters or running online ads are expenses too because they help generate sales but are not long-lasting. Expenses are incurred to earn revenue and are usually used up within a short period. They are typically used up quickly, like paying for salaries, rent, or electricity. For example, paying monthly salaries or the cost of electricity used are expenses that keep the business running. These are everyday operational costs necessary for daily business activities. Expenses are called revenue spending items or revenue expenditure because they are spent to earn current income. This is different from capital expenditure, which is for long-term assets. Revenue expenditure examples include utility bills, office supplies, and advertising costs. These costs are for the day-to-day running of the business and are used up quickly. Capital expenditure, like buying a new van or computer, is for assets that last many years. Revenue expenditure, like paying the electricity bill or buying pens, is for items used up quickly. Both types of spending are important, but it's crucial to know the difference. Commerce Sensei always reminds you, clearly distinguish assets from expenses. This will help you make better business decisions and keep your accounts accurate. Remember, assets are for the long term, while expenses are for the short term. Keep practicing, and you'll master this difference. Now let's dive into the golden rule of accounting. a classic traditional approach that forms the backbone of bookkeeping. This method is often the first thing taught to accounting students, and for good reason. The Golden Rule classifies all accounts into three main types: real, personal, and nominal. Think of these three types as the wings of a bird. Each side must always be equal and balanced, just like every accounting entry. Let's explore each type with clear examples, so you can understand how the rules work in practice. First, real accounts. These relate to all assets and properties of the business, both tangible and intangible. For example, land, buildings, and cash are all real accounts. Even goodwill, which is intangible, falls under this category. The rule for real accounts is simple: debit what comes in, credit what goes out. If your business buys a building, you debit the building account because the building comes in. If you pay cash for it, you credit the cash account because cash goes out. Next, personal accounts. These relate to all persons, natural, artificial, or representative. For example, customers, suppliers, and banks are all personal accounts. Even the capital account, which represents the owner, is included here. The rule for personal accounts: debit the receiver, credit the giver. If you pay a supplier, you debit the supplier account because they receive the money. If a customer pays you, you credit the customer account because they give you money. Finally, nominal accounts. These cover all expenses, losses, incomes, and gains. Examples include rent, salary, commission, and interest. These accounts show the day-to-day flow of money in and out of the business. The rule for nominal accounts: debit all expenses and losses, credit all incomes and gains. For example, when you pay rent, you debit the rent account because it is an expense. When you receive interest, you credit the interest account because it is income. The logic behind debit and credit is always about balance. Every transaction affects two accounts, keeping the books equal, just like the wings of a bird. Commerce Sensei reminds you, practice these rules with real-life examples, and you'll master the golden rule in no time. Let's now learn the modern rule, which is the foundation of today's accounting. This is also widely known as the accounting equation-based approach. It is used by businesses and students everywhere. The modern rule is more direct and practical. It helps you see how every transaction affects the business. It uses 5 main pillars: assets, liabilities, expenses, income, and capital. The accounting equation is simple. Assets equal liabilities plus capital. Or in numbers, if you have assets worth 10,000 rupees and liabilities of 6,000 rupees, your capital is 4,000 rupees. Let's look at each pillar with examples. First, assets. These are things you own, like a laptop for your studies or a delivery van for a business. For example, if you buy a new laptop for 50,000 rupees, your asset increases. You debit the asset account. Next, liabilities. These are amounts you owe, like a loan from a bank or money borrowed from a friend. Suppose you take a loan of 20,000 rupees to buy that laptop. Your liabilities increase. You credit the liability account. Expenses are costs you pay to keep things running, like electricity bills or buying notebooks. If you pay 500 rupees for electricity, your expense increases. You debit the expense account. Income is the money you earn, like receiving a scholarship or getting paid for a part-time job. If you receive 2,000 rupees as a scholarship, your income increases. You credit the income account. Capital is the owner's own money invested in the business, or your own savings used for your studies. For example, if you add 5,000 rupees from your savings to your business, your capital increases. You credit the capital account. For assets and expenses, when they increase, you debit them. When they decrease, you credit them. Let's see a simple example. If you buy a book for 300 rupees, your asset, book, increases and your cash, asset, decreases. Debit book, credit cash. This keeps the equation balanced. The total debits always equal the total credits, just like the 2 wings of a bird must be equal for it to fly. If an asset account balance increases, debit it. If it decreases, credit it. Similarly, if an expense account increases, debit it. If it decreases, credit it. For liabilities, income, and capital, the rule is the opposite. When they increase, you credit them. When they decrease, you debit them. For example, if you repay part of your loan, your liability decreases. You debit the liability account. If you earn more income, you credit the income account. If you use some of your capital, you debit the capital account. Remember, every transaction affects at least 2 accounts, and the total debits and credits must always be equal. This balance is the heart of accounting. It keeps your records accurate and trustworthy. Golden Rule uses 3 account types, but the modern rule uses 5 pillar types directly. Many students find the modern rule simpler because it links directly to these core pillars and real-life examples. Practice with your own examples. Think of your pocket money, your school fees, or your savings. Try to record them using the modern rule. Keep on learning with Commerce Sensei. We hope this was very clear. Like and subscribe Commerce Sensei for more such informative videos.